Well, hello and welcome to our Midland Wealth Management 2023 Market Outlook. I'm Jayne Hladio, President of Midland Wealth Management, and we really do want to thank you for joining us today. We know your time is valuable. This forum, in the way we design it, underscores our commitment to timely and really frequent communication with all of you. And I believe, as I'm sure you all do too, uncertain times like these, it's more important than ever for us to connect with our advisory experts and have time to really focus on your goals and clarify your priorities. And I think very importantly right now, discuss your risk tolerance frequently. One of the best approaches and ways that we can do this into the new year is to engage with your team of wealth professionals. And we have really taken time to think about how we can do our financial planning process even better. We really want to fine tune the position this year because we do believe it is a bit of a tale of two markets, likely two halves to the year. So today we're going to offer ways to navigate by sharing some key themes that we believe will impact 2023 investment strategies. We do want to entertain your questions. That's important to us. So feel free to tee those up and Chris will watch those for us and we'll cover off on them in the Q&A today. So it is my pleasure to introduce our featured Chief Investment Officer, Betsy Pierson, today, along with our Senior Portfolio Manager, Tracy Garst. Their combined experience in navigating numerous market cycles is so beneficial right now. You just cannot substitute deep expertise that offers really valuable insights as we move into this next year and in the future. So Betsy and Tracy, we're thrilled to have you join us today, and thank you for helping us lead the discussion. So without further ado, let's go ahead and dive in. Between a pandemic and a war, we've got the economic challenges in China, inflation, the risk of a recession. The market environment, I think, has been quite challenging. That's probably underscoring it in many ways. And we do believe that the 2022 asset class returns that are reflected today on this slide, it's very fair to say that there aren't many places to hide unless, in fact, you invested in commodities or cash. So we know last year has gone down in history as one of the most challenging, likely one of the worst years for the 60% equity, 40% bond investor with the double-digit negative returns. But let's not despair. There is a silver lining. The S&P index was certainly low as well since 2008 in terms of bond returns, as measured by Bloomberg Barclays U.S. Aggregate Bond Index. They were the lowest since 1976, for those of us that can remember that year. And moving from a zero interest rate policy to an aggressive rate hiking cycle that weighed very heavily on the fixed income returns, doubled over into the equity markets as well. So, as I said, though, there is a silver lining, and 1 year doesn't make an entire trend. It's fair to believe that the worst case scenario for most risks have likely been priced in at this point. And as such, our theme for this year is going to be Good Riddance 2022 and Welcome 2023. It seemed most appropriate in terms of a reset that occurred in 22 and what we think will be another challenging year, but with glimpses of optimism into 23. So Betsy, that's the intro, and let's start with you. And we'd love for you to be able to provide us with an overview of, gosh, where is inflation now and how is it going to continue to impact this year's market? So Betsy?
Thanks, Jane. Let me change the slide. So inflation has been at the top of the news, as you know, over the last year. Interestingly, inflation hit a peak in the overall CPI in the summer last year at around over 9% year over year, the highest we'd seen in probably almost 50 years. Since then, it has rolled over. Core CPI, the green chart here, the green line here, peaked later in the year and has started to trend down. We think that's a good sign, but it's still not anywhere near what the Federal Reserve is targeting. And it definitely needs to move closer to that 2% target that they're looking at. But if you look at the rate of change on the lower left column over the last 3 months, so if you look at overall consumer numbers, October they were 0.4, November 0.1, December negative 0.1. That annualized on a basis is less than 2% annually. Now, will it stay that low? We're not sure. There's some other factors that go into it. When you start looking at the core, While that has declined, it has not declined as dramatically. It's still ranging in around that 4% level year over year on the last 3 months, but it has come down to a more reasonable level. And maybe the Fed can think that they've done some of their job, but not completed it. Some of the things that feed into that, we had the pandemic. We saw dramatic increases in used car prices, freight prices, because there just wasn't enough shipments, a number of other things. Those have all rolled over. The pre-pandemic, they're back to pre-pandemic levels, maybe even a little bit lower on an inflation basis, not on price, but on the rate of change in price. The one other thing that's declined is the retail gas price. This was when it was $3.17 a gallon. I don't know if many of you have been out lately buying gas, but it's not $3.17 a gallon anymore, unless, at least not in the state of Illinois, due to high taxes. But it had been that low before Christmas, and now we're back to probably that $3.50 area. Natural gas has done that, was impacted by the war. The one thing that they're going to continue to watch is the owner's equivalent rent and wages. Wages have flattened out in their level of increase. They're still higher than they were pre-pandemic, but they tend to be slowing a little bit in this market. And I'll go into that a little bit later and with some other questions. But the one thing that is impacting inflation still is the owner's equivalent rent. And that typically lags both on the upside and the downside, and actually moved lower in 2020 and into early 2021 because landlords were unable to raise rents due to the moratorium on kicking people out of their apartments and a number of other things during the pandemic. So in early 2022, the landlords took their chance and they raised rents pretty dramatically. I don't know if you knew anybody who was looking for an apartment during that time frame, but rents went up about 25 to 30% in that 2 or 3 month period. But it appears that they may have hit a peak. And one thing that will show into that as you look at this next chart. And what we have here is the price changes on Zillow and apartments. And you can see in 2020, both of them declined, especially the apartments, because they couldn't raise rates at all. And then going into 2021, when they were able to, home prices increased with the demand for homes on Zillow, as well as the apartment pricing. Both hit a peak probably the middle of last summer, in the middle of the summer of 2022, and have since started to decline. But as I said, the CPI shelter, the owner equivalent rent, that is a laggard. It lagged going down. It doesn't move as much, and it's lagging going up. But will it follow? I think that's the big question. Owner's equivalent rent in the CPI number tends to be a little sticky, very slow to move, but it appears that its rate of change is flattening to declining, which should help the overall CPI number and the inflation rate going forward. I always like to remind people, the inflation rate slowing back to that 2% level doesn't mean that prices are going to drop from here. It just means that the rate of change of price is going to be substantially less than it has been the last 12 months. So don't expect prices to decline in most parts of the market, but do expect that the rate of change will decline. Eggs may change, but that's a whole nother topic. Eggs are. So
Fair enough,
that's
Betsy.
really, I think when we look at inflation has peaked, but it still needs to come down to where the Fed really wants it to be, and when they'll continue to fight that.
It makes a lot of sense. And, we have endured quite the aggressive tightening cycle. The Fed's been so aggressive in monetary tightening. So when we think about taming this inflation and this challenge ahead, Betsy, what's the market expecting there, and what are we thinking about going forward?
Okay. As we all know, the Fed went into the most aggressive tightening cycle in its recent history. And this is just looking at, some different economic environments, even back in the 80s, the 90s, it was pretty dramatic. We went from 0 to 4 in 9 months. It's a phenomenal move. And with that, they're really aggressively trying to tame inflation. They were putting, the metal to the pedal, ready to go. What's going to happen? We do think that they're 90% of the way done in what's going to happen. What happened really, though, and even Jayne covered this a little bit in the opening, is with that going from zero interest rate policy to a more aggressive interest rate policy of tightening and trying to slow down the economy, it did lead to some very negative returns in the bond market. It's very hard to go from 0% to 4% and not have negative total returns. And the Fed was well aware of that when they took this on, knew the pain the consumer and the investor was going to feel, but they had one target, and that was to fight inflation. When we look at where they think, the market thinks Fed's going to go, here we are on February 1st, they're going to raise rates another 0.25%. So we'll be at a 4.5% target rate. The market is building in 1 to 2 more after that. But it will depend on what inflation does. But then they're going to pause. And what's interesting is that the market is anticipating that they're going to start lowering rates later this year. I don't know that that's going to happen, but I do think we're close to the peak. 5% is the target rate. Whether we get there or not will be the question. And it will depend on what happens with inflation and the economic environment that we're in.
Good enough, Betsy. There's so much discussion about how the recession is, what timing it's arriving at, how hard it's going to be, if we can stick that soft landing. And I know you and the team have been monitoring many different gauges to just discern what direction the economy will go in. So we'd love for you to take us through a few of those and what your thoughts are.
Yeah. What's interesting is this is the most anticipated recession ever. When you look at this chart, you can see that over, almost 50% of the economic prognosticators, the professional forecasters, anticipate a recession in the next 12 months. We haven't seen this level, so if you want to be a contrarian person, you could say, well, they're never right. And if they're all thinking it's going to be a recession, is there not, maybe it will never happen. That's a question. Will it happen or will it not? But we haven't had a quote unquote real recession since 2008. Yes, we had a recession in 2020 that lasted about 3 months, and it was primarily due to the pandemic. It wasn't because the economy moved into a recession on its own. It moved there because we shut down the globe and things just stopped. And that's a different environment. This is more of a typical business cycle where we have excess demand, more inflation, and the Fed raises rates, tightens, and tries to slow the economy down. Their goal, ultimately their goal is to have a soft landing. But if you listen to anything that the Federal Reserve has been saying is, we don't care if we go into a recession. We want to fight inflation. So they're going to do what they need to do to get inflation back in line. We can all debate where the inflation came from, why it happened. Were they behind the curve getting there? But they don't want to be wrong in getting inflation back to that level. With that, they could possibly throw us into a recession. The next chart really shows, while you're looking at, there's 12 indicators on here that indicate a recession is impending or it happens during a recession. 8 of those 12 are showing a recession. 2 of them are cautionary. Other than 2020, all of these have been pretty close to where we are right now. The one thing that's not there yet is jobless claims, and the job market is a whole nother thing that, we can look at. And then truck shipments. And I think truck shipments aren't negative yet because people do so much shipping and they're still catching up with the supply chain issues. But that can change if our supply chain issues get in line and demand falls. So you look at this and you say, oh, a recession's on the horizon. This is what those forecasters are looking at. Another thing you can look at historically is the yield curve. Not that the yield curve is always right, but the bond market tends to kind of lead in some of these kind of environments. And when you look at this one, you would say we have an inverted curve, which means that all the short end, so you look at here, 3 months, 6 month, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, everything is higher than the 10-year treasury. And it's very inverted in the short end going into the intermediate part of the curve. And the 10-year is actually, or the 5-year and the 10-year have actually declined since the beginning of the year. If you're a treasury yield curve watcher, this would tell you that there's going to be a recession in the next 6 to 12 months. The 10-year is anticipating that. It falls in advance of that. And then the rest of the curve will follow lower as the Fed sees the recession and ultimately begins to to loosen and lower rates. Is this going to be correct? It is yet to be known. But if you follow this, you would say there's a recession on the horizon. Another indicator, which is almost always correct, as you can see, is the leading index indicators. So there's 10 economic numbers that they look at that builds into the LEI, which is the leading economic index, and they have been negative for the last 10 months. That is historically the longest we've had a negative time period without having a recession. So if you look at just the leading indicators, which are made up of the average work week, jobless claims, consumer goods orders, ISM new orders, all the business orders which are like leading numbers, new orders, all those building permits, expectations, they're all negative at this point. And so you would say, if this is correct, we should have a recession sometime in 2023. The caveat is, we've had these really loose financial conditions, and financial conditions usually tighten dramatically as we head into a recession or in a recession. And that's primarily due to the Fed's tightening. The Fed's raising rates, the Fed's trying to slow down the economy. We are just coming off one of the loosest periods in history and getting back to a more normalized level. So maybe the financial conditions aren't as tight as you would normally have to go along with some of those other indicators. The good part is it's not restrictive at this point, but it has risen dramatically to become more tight and tighter financial conditions, probably at the speed of light compared to other time periods. And it's really happened outside of a recession. So, and we could argue about this too, but this part of this happened in the pandemic with excess stimulus from both the government and the Fed that caused very easy money conditions, which ultimately probably led to the inflation that we have today. So they're trying to reverse all that. As we lead into, another chart going into this, even if the positives you could look at from a soft landing rather than a recession could be the consumer and even businesses. Their debt service ratios are actually in line and they're in fairly good financial condition. As long as, consumers have jobs, businesses have really cleaned up their balance sheets since the great financial crisis. We're in pretty good shape from a financial standpoint. So the consumer debt service is still below the normal, it has been increasing. The question is, are consumers beginning to use their credit cards and borrow against their homes to live? And if that's happening, this will increase. And anything that's floating rate, like a credit card, a revolving debt, it's higher interest rates now than it was 6 months ago, 8 months ago, a year ago. So that cost will go up. So we're going to monitor that closely. But at this point, the consumer is probably one of the stronger points in our economy and continues to be. And part of that's due to the fact that we have this exceedingly it's not as tight as it was, but we have a fairly tight labor market. Yeah, we've heard that, the large tech companies and some of the other large companies are laying off people. Well, they probably overhired in the pandemic, thinking the business was going to continue to grow as dramatically as it was, and they hired all these people. But it left the small and mid-sized businesses without employees. If you go out and talk to small and mid-sized businesses now, and if someone has some input to feed to this, they're just getting to the point where they're just like at the right employment level. So they're not going to lay off people yet. It would have to become a very dramatic recession for them to really cut back on employees. And maybe we can bring more people in the labor market at some point to help this. But, if you look at the right-hand chart, which is the job openings, the JOLTS index, it is the number of jobs open to the number of available workers. The Fed would be much happier if this was closer to the 1 level rather than the 1.83 that we saw in November and December. And I think this has come down a little bit even in January, and it's starting to roll over, but there's still a lot of job openings, which may be pulled as we have a slowing economy, but it will get closer to that 1. So even if we do go into a recession, we don't believe that the unemployment rate will go dramatically above 4.5% or 5%. We've got a shifting labor market. We have, baby boomers who have retired and more retiring every day. people leaving their business, they feel confident in that. They've just wanted out of the workforce. So we just need to get that stabilized. So 4.5%, 5% unemployment would be a perfect place to be. A slight recession would probably achieve that. But even a soft landing might get us there. So we would look at it and say, the labor market and the consumer could help maintain this soft landing. Along with it, the soft landing could be, a weaker dollar. It helps our manufacturers or anybody who sells globally. If we have a weaker dollar, our product will become cheaper, relatively speaking, to our international trade partners. Will it increase their demand? Will it help soften some of our economic slowdown so it's not as drastic? The same with China. We get in the US, the revenue exposure to China is almost 7%. As China reopens and continues to reopen, their demand is going to increase, which should help some of the trading part of it and possibly help us grow. So in reality, we may have a recession. It's the most anticipated recession, but even we may have the soft landing. But if we achieve that soft landing, wonderful. But if it is a recession, we don't anticipate that it's going to be a deep, long recession like we had in the Great Financial Crisis. Probably more like that 90, 92 one, where there were people impacted, but it wasn't like it shut down the world. It just needs to get the supply-demand back in balance and get things back to the normal. As we like to say around here, recessions aren't bad. They're just part of the cycle, and they help clean out the excesses to get us back to a good base to build forward. So we like to think of it that way. And, if we have a recession, there are things we can do, but, it is part of life.
Well, Betsy, what I hear you saying is embrace it with eyes wide open.
Right.
And for many of our constituents and clients on the line, this is where our strength really comes through, whether you're a consumer or you're a business owner. Everything from the banking advice, the business owner advice, the treasury, the cash management, trust, investment advisory on up, we have it. And so I think it's critically important when we switch gears here a little bit, and I want to go to Tracy for a moment. You think about some of the scenarios we're embracing, it seems almost like the economy, the market is trying to figure out what the new normal really is. So Tracy, where do you see the primary areas of concern for stocks in 23?
Yeah, thanks, Jayne. Needless to say, there's a whole host of concerns that we are facing going into this year. Many of those are geopolitical concerns. Aside from those, I'm really going to focus mostly on stocks and not only try to put things into perspective, touching on the positives as well as the negatives that all investors are facing this year owning stocks. So with that said, the first chart here that I think could actually be a headwind to stocks this year is simply dividend yields. As you can see from this chart, the Fed has been extremely aggressive raising interest rates and bond yields following higher. And this is one of the first times in quite a while that bonds are actually a good investment alternative to the stock market based on yields. From this chart, you can see in the pandemic of 2020, almost 80% of all the S&P 500 stocks companies had a dividend yield higher than a 10-year Treasury note. So there really wasn't much of an alternative for stock yields, except to go into stocks. And you can see now with the Fed raising rates as aggressively as they have, less than 20% of the S&P 500 companies actually have a yield higher than a 10-year Treasury. Why is that a negative? Well, it's a negative because clients and investors are finding that it might be very comfortable for them to sit on a 4%, 4.2% 2-year Treasury note and not put money back in the stock market. So we may see money sit on the side and opting for fixed income more so than the stock market until we have more proof that we're through this bear market and potentially heading into the next bull market. And something that's ironic here, so is this good or bad? As Betsy said earlier, we think the investing environment is actually becoming more normal. If you look at this chart, 20% of stocks yielding more than the 10-year Treasury. Honestly, that's just simply getting back to what was a normal range from 1974 to 2008 when we had the global financial crisis. So the Fed and their quantitative easing and zero interest rate policy basically spurred on the excesses that we've seen in the last 15 years. So again, this isn't all bad. We think that we are actually getting to a more normalized environment as we move forward. Another primary concern, and of course, this is the one that's being talked about on a daily basis, is where is the market current valuation sitting and is it appropriate? Currently, the S&P 500 price to earnings multiple is around 17. And if you look at that, that's pretty close to our 25-year average, which over time we would say is actually pretty good. It just means that the market is not dramatically overvalued compared to what we would expect it to be. The problem we have with this is the E, that earnings number. Things are slowing down, global economy is slowing down. The earnings estimates are coming down and they have steadily declined. And the question then is, what is the correct earnings number for the S&P 500? If earnings continue to go lower, then a 17 PE isn't 17, it could be a 19 or 20. Now, historically, when you have bear markets, PE multiples do go up as earnings fall. But the question and the thing everybody is trying to figure out, how far do they need to go down? And that's what we are right in the heart of earnings season right now and beginning to see some of these numbers come out. Generally, they've been okay. No major declines, but it's early into that season. So this is a big concern as we move forward that we're monitoring is where are we with earnings estimates as we move forward.
Yeah, you know, Tracy, on this one, this again, I think the power of having good advice, you know, everyone's struggling to figure out proper valuation against the discount backdrop is what we see. And so, you know, trying to figure out who's generating cash flow, you know, if it's maybe a little less growth by acquisition and more by organic growth rates as interest rates, you know, seem to go up, that really requires a really healthy customer focus and a pretty darn good plan. So I love the way that you and Betsy and the team, we continue to be very selective on, you know, what to own and kind of what size position to be in. So really insightful here.
Thank you. Yeah, we talked last year about how we were going to have a reset when it comes to PE ratios, and quality matters, earnings matter, balance sheets matter, and dividend matters. And I actually have something we'll talk about later about dividends and the importance of it. But timing is very difficult. And that's one of the concerns. All the talking heads are trying to figure out, you know, are earnings going to bottom in the first quarter, second quarter? When are they going to bottom? I think more so is the trend. And if you look at the earnings growth, that it has been slowing globally. Now, granted, earnings have come down from the May 2021 peak. That was unsustainable. We were not going to maintain those type of earnings growth rates coming out of the pandemic. However, if you look at like from November 2021 to really May of this past year, 22, earnings were pretty stable between the 5 to 8% range of growth. When it really started to take its next leg down was when the Federal Reserve started raising interest rates. And that reset is ongoing. We are seeing earnings growth rates continue to fall. Trying to figure out when it will bottom. Nobody knows that answer. For the most part, you want to be in before that happens. And we don't know, but we know we're quite a ways through that process. It could go lower. But ideally, we want to start to see these things bottom. And if we go flip to the next page is profit margins, and that's something we're watching really close. If earnings are going to decline, which they are, profit margins are going to follow. And you can see S&P 500 profit margins have come down quite significantly, and they peaked also in May 2021. But what is fueling the profit margin decline is what's on the right-hand side of the chart. Three main things we got to focus on. The blue line, which is pricing increases. Companies have really raised prices with inflation about as much as they can. We don't think that's going to be a real alternative for them to continue doing. The next thing would be the green line, which is compensation, wage growth. Wages have grown significantly, which has driven up inflation dramatically. It is starting to roll over. And as Betsy said, with the shortage of workers, it has remained fairly high. And then the black line, of course, is more important. These are sales. These are the revenues, projections, and the estimates going out. Those estimates have plummeted. The positive here would be, if you look at that chart, 2008, we had a bottom and turned up. The pandemic of 2020 bottomed and turned up. And it looks as though we may be forming a bear market bottom here, kind of a recessionary bear market low on those revenues. So we're keeping an eye on this continues. If we see revenues continue to hold in there, maybe we have seen the worst of it. But profit margins are going to be extremely important. This is why you're seeing companies start to lay off, and that will likely continue as we move forward. And the biggest concern would be earnings estimates. And I've kind of what we look at is how many companies are raising estimates, positive revisions on the upside, and how many are lowering estimates, the negative revisions. And this is something that we call, it's the earnings per share revenue sentiment indicator. And these revenue earnings per share growth rates have continued to go down. So basically what that means is there's more companies lowering earnings estimates than are raising them. And again, similar to the last page, what we see here in a recessionary bear market, 2008 and 9 bottomed and turned up. Those are my red circles. 2020 bottomed and turned up. And it looks as though those sentiments here, revision sentiments, may actually be bottoming and beginning to turn up. If that is the case, and we believe that this would very well follow through, it's another sign that maybe earnings are close to a bottom, and the market will likely find a bottom in the near term. So that's kind of a negative that we're watching, but potentially a positive. And I think what is very, very important in this environment, as Betsy said, recessions are a normal part of investing and part of the cycle. We haven't had a true recession for quite a while, a real recession like 08 and 09. We had the short one in the pandemic. But if you look at earnings revisions, the thing this shows is you can't wait for earnings to bottom. The market will tend to recover and bottom before earnings ever bottom. And this is a chart of the global financial crisis, 2008 and 9. And you can see from the green line, the market actually bottomed well before earnings actually bottomed. And there was a very significant upward recovery in the stock market well before those earnings bottomed. So nobody knows when that's going to happen. We believe you want to be in stocks after the decline we've seen and the earnings deterioration we've seen. And that's why for our portfolios, we are pretty much neutral in stocks. We're not underweighting stocks. We really did not add to our equity exposure until June, July of last year. And we did so, brought it back to neutral, and we're slightly overweight now.
So Tracy, it's a bit of a two-way kind of action, choppy market movement. It's ebb and flow, and it seems to be kind of evolutionary as we move forward. And you did describe the bear market that we've been in since January of 22. So let's dig into the market cycle a little bit more. Do you think we've seen the worst of it? Where are we?
Yeah, I think that's a great question. You know, where are we in this process? And I would emphasize bear markets are a process. There's no strict definition when they start, when they end, and there's no real definition as to are we out of it yet. But there's certain things we can look at, and we call that are we there yet? We think we're close. If you look at this chart, the average recessionary bear market is down approximately 30% from the peak. And I throw this out and say the recessionary bear market, we really haven't had a recession yet. As Betsy said, it's probably the most anticipated recession we've ever had if we don't get it. But normal bear markets are down 20+%. Average recessionary bear markets are down closer to 30. We were down 25% in 2022 from the max, from the peak. And that is kind of in between bear market and recession. Betsy and I had a long talk yesterday looking at different bear markets. 2007 and 9 was a global financial crisis. We don't believe that is anything like what we're seeing this time around. There were significant structural problems in the global financials, in the global finance that we're not seeing. 2001 was a technology bubble. I think that was totally different. And 9/11, yep, you're right. We had that in the same period. 73, 75 was interesting because, yes, we had inflation, which is what the Fed is really concerned about, but two very important factors. Number one, we went off the gold standard that year, had a big impact on financial asset valuations, and we had the oil embargo. We were basically oil dependent, which no longer are we. And then I would throw out 2020 down almost 34%. That was a pandemic. Remember, nobody knew what was going to happen there. We didn't have the vaccinations until November of that year. So all of these things recovered. Doesn't necessarily mean we have to go down 30 to 35%. No, it doesn't. Could we? Absolutely. I mean, there's no doubt that we could maybe retest the lows we saw in October. But we think we are through much of the worst of it, could potentially do a retest, and we would look at that and say that's a buying opportunity if we should. A couple other things that I think are showing that the markets maybe have signs that we've worked off some of these excesses that we've seen. And number one is market speculation. You usually have a big bull market blow off with huge speculations in the market, tech bubble, for instance. But one thing we had was margin debt skyrocketed. If you look at this chart, we didn't get quite as high as the tech bubble in 2000 or back to what we saw in the late 80s, mid 80s. But margin debt was very, very high. As we know, it was very, very attractive for individuals to borrow cheap money and invest it in stocks, leverage up, and they did pretty well for a while. And that is no more. That is gone. And you can see how the amount of leverage has just plummeted. We are down to levels we haven't, getting close to levels we saw in the past couple bear markets of 2008 and 9, and also the 2000 tech bubble. So we think this is actually a positive. This is a bullish situation for stocks when we see this type of negative sentiment. I'll call it pessimistic sentiment. The next page is another thing we look closely at is the consumer sentiment index. And it's a contrarian indicator. When the consumer sentiment index has very negative readings, historically, that has been very bullish for stocks. That has been a good time to buy the stock market. You'll see from the green, we bottomed on sentiment around June of 2022. And we hit the lowest level we've hit since 1980. We actually went lower in sentiment than we saw in 2008 and 2011. So the point here to be made is if you look at the blue percentage rates under each of the blue dots, those are the 12-month returns of the S&P 500 on when we finally saw a bottom in this sentiment indicator. So the lower this got, the much stronger upward moves. You know, Warren Buffett always says you want to buy when everybody is fearful. So when this consumer sentiment is extremely pessimistic, you want to be buying. You want to sell when everybody's greedy. Like if you look at January of 2000, was the perfect time to get out. So we think this sets up very well as a contrarian indicator for the market and a reason to be bullish. And looking at dividend growth, I think it is an area that we, not knowing where is the bottom, are we at the bottom? You want to really own stocks that have good fundamentals, strong balance sheets, really strong free cash flow, selling at reasonable valuations. And to us, these are dividend growth stocks. Interesting, looking at dividend growth, we actually added dividend growth to all of our portfolios last June and July. And the reason is they tend to perform very well during a Fed interest rate cycle where they're raising interest rates. After the initial hike, during the length of the time the Fed is hiking rates, and even after the final Fed interest rate hike, 3 months, 6 months, and 12 months later, dividend growth stocks do very, very well. And they're much more defensive, more exposure into healthcare, consumer staples, but very, very strong blue chip, good balance sheet type companies. So this was an area we really, with our strategy last year, added to, which helped some of the downside last year. And then one last positive I will throw out there is if you look at the current trend with consumer price index, historically, stocks tend to bottom when inflation peaks. As Betsy indicated earlier, June may likely have been the peak of this interest rate inflation cycle. If that's the case, this chart on the right shows each of those blue dots on the left as to what their 1 year, 2 year, and 3 year returns were after the peak in consumer price index. So if in fact inflation has peaked, which we tend to believe it has, we should start to see stocks perform better as we move 1 year and 2 years out. I would add here that we do believe we're beginning to see some of this. Market breadth has gotten much better. And what I mean by that is the number of stocks that are currently trading above their 200-day moving average is up over 62%, which is a bullish signal. Also, just look at the market as a whole. Small caps have performed better, mid caps have performed better, and international have performed better. The area that has struggled has been in technology, but our viewpoint is many times the stocks that lead going into a bear market aren't the leaders coming out of the bear market. So it doesn't necessarily mean that tech has to be the leader. So we like the improvement we're seeing in market breadth right now.
Well, I wish we had a crystal ball. I think we all do. But Tracy, we have a ton of experience. We've got an enormous amount of intelligence here too that we've presented today, but let's see if we can get even more specific around some of the opportunity areas that we see in the equity markets for our participants today. Thoughts on that?
Yep, and we think there are a couple of really nice opportunities right now. Last year, we took advantage of the dividend growth opportunity. This year, trying to put our playbook together for this year and what we're looking at as this year progresses, We think small cap stocks are looking very attractive at this point. And we think this is one opportunity for this year. Valuations are cheap. If you look at this chart, these are small cap stocks comparison to large cap. They are the cheapest they've been since the technology bubble. So we think small caps offer a nice opportunity. A couple other things on small cap on the next page. Small caps tend to lead coming out of major market downturns. You can see the tech bubble. Small cap stocks were the leader over large caps. Global financial crisis, same thing. COVID, when we came out of the COVID pandemic, small caps dramatically outperformed. And if you look at 2022, small caps and large caps were down about the same. We think there's a lot of outperformance in small caps. And then the last thing to look at for small caps is how do they do during inflation? And since 1930, small cap stocks are the only asset class that's outperformed inflation in each of the decades since the 1930s. 14% annualized returns compared to the CPI at 3.1. So a lot of things are setting up to really favor small cap stocks. We are currently market weight small caps, but looking for opportunities to probably go overweight small caps. The other area of opportunity, believe it or not, after 15 years of underperformance, could be international and emerging markets, primarily due to the weak dollar or what we see as a weakening dollar. When you have a strong dollar, if you look at the S&P 500 and the investment grade bonds, whether the dollar is strong or weak, they tend to perform about the same. However, when you have a weak dollar or a falling dollar value, MSCI EFA International does very, very well. And the biggest benefit is to emerging markets when the dollar is weakening. So I think the difference is for 15 years, we have had quantitative easing, 0% interest rates for the most part, a very, very accommodative Fed. That has really favored U.S. stocks. However, that is now in the rearview mirror. It could very well be that emerging markets and international becomes a pretty attractive place. Their valuations are cheaper at this point, and the weaker dollar should really help. We have a slight overweight to that area right now.
Well, thanks, Tracy. And I think we would be remiss if we didn't head into a bit of a discussion here on, kind of reminds me of echoes of 2011, but the debt ceiling battle isn't anything new on Capitol Hill. Betsy, I know you and I talked about this yesterday. There may be a bit of undue, fear out there or volatility. The U.S. hitting the debt ceiling on the 19th. And it's probably going to be quite a consequential policy debate for this year. But we've got a lot of information here that we just went over for the last 48 minutes. Betsy, your summary thoughts and perhaps some insights on the debt ceiling debate.
Yeah, it is truly. I mean, I was looking at one of Tracy's charts of the debt ceiling. And you look at August 2011, when consumer sentiment hit one of its low points. That was because of the debt ceiling. So when we look at the overall picture, we'll get into that. I think it is one of our headwinds. The tailwinds are that inflation's peaked. The Federal Reserve will probably pause. We have a weaker dollar. China's reopening, and maybe a recession can be avoided. The headwinds, if inflation picks up, the Federal Reserve keeps tightening. How deep will the recession be? Equity markets, as Tracy went into, and then always our ongoing geopolitical issues. But I do think on a near-term basis, meaning between now and June, when supposedly we run the risk of default from the government on treasuries and their payments, is the debt ceiling debate. And I always like to say, Washington hasn't learned how to play in the sandlot very well together. And this is one of those discussions. They all need to learn how to work together, but, they all have their political agenda, and the debt ceiling is one of them. We even had a discussion this morning that, maybe they should just get rid of the debt ceiling and make the debt issuance and the discussion around the budget, not around this. And we would get rid of a lot of ploys because a lot of things get thrown in the debate that become extra expenses as they approve this. We do believe that it will get approved at some point in June before we default on our debt. I don't think even the Congress themselves cannot afford to have the U.S. default on debt and not make interest payments or Social Security payments or whatever. They would all be out of jobs. So I think they'll get their act together at some point. But like we saw in 2011, it was a very volatile period. And with that, Treasury yields went up because they were afraid they were going to default. The stock market went down because they were afraid they were going to default. It caused more volatility. We could see that over the next 4.5 months. And it's going to be out there and it's going to be in the news and people are going to ask about it. If the government defaults on the debt, there are many longer term ramifications to this country that Congress needs to be aware of. And hopefully, I think we believe as a group as we talk, they will get it solved. It will go to the 11th hour and it will be out there and it's going to be a headline and we all need to be aware of it. But I would even summarize with that while we have the volatility in the market, we have a couple additional charts that we want to point out to people. And one of them is you need to be in the markets for long term. As Jayne pointed out in the beginning, planning and figuring your risk tolerance and what your allocation should be is the key to all investments. And once you decide that and you're on that plan, you need to stick with it. So this chart basically since 1936 says that if you sold 10 months prior to the peak and you bought 10 months after the trough, that investor was much worse off than the buy and hold investor over a long-term time frame. So, that is, it's a key. And bear markets don't last forever. They're volatile. They're, as Tracy and I both said, they're a good flushing out of excesses, but things do recover. And when you look at, charts, in recessions, markets go down. Bear markets go down before the market goes before we're ever in a recession because markets are always forward looking, pardon the horn. But they rebound and you can't time it. You have to be a long-term investor in the right allocation. And the final chart is the long-term approach does pay off. This is the stocks, bonds, and a 50-50 portfolio. Yes, 2022 was an abnormal year. You can't go from 0 interest rates to 4% and not think you're not going to lose money. But we're in a more normal environment for interest rates, back to what we were prior to the great financial crisis, as Tracy and I were talking about. Over the long term, if you are a 50-50 investor, 10 years, 20 years, 5 years, you have not lost money. You make money. You need to be a long-term investor and keep it. And that's a fairly balanced 50-50 portfolio. You're not taking an inordinate amount of risk, but you are off, ability to get growth. And that is the key, and to be that long-term focus. We like to watch things short-term and near-term just to know what's going on. But I would stress that long-term, you have to stay with the markets. You have to stay invested according to your plan. And the plan is the key to get the result that you want. Are there any questions?
Thank you. Yeah, I think I did see a couple questions out there, Betsy. Chris?
Okay.
Yeah, so we have one question. Why do you think the market is pricing in cuts by July 23, even though there are no indications from the Fed that they plan to ease this year?
Well, I would step back and say the bond market and the people who do that pricing, it's all, traders and bond market people who are involved in it. The bond market, while I have been a bond person for a long time in my life, I'm not the typical bond person because bond people tend to be negative. They always look at the negative side of things. And I think the bond market and the Fed funds market is looking at that. We're going to have this recession. The Fed's going to have done too much and they're going to lower rates. The Fed's saying they're not going to. I don't know that they're going to. I think they're going to be happy at the rate level they're at, and hopefully they're done soon. But the bond market is looking forward, and they always take a negative tilt. I hate to say it, but if there's any bond investors on this call, if you talk to a bond trader, they're always looking at the negative, not at the positive, whereas equity people are always looking at the positive, not the negative. So I think that's why that is priced in there.
Any additional questions, Chris?
Good one.
No, that was the only question we received so far.
I think I see another one coming in. How do you view currencies? Chris, can you finish that question?
Yeah, so Betsy as well. How do you view currencies? And I guess the second part would be for Tracy. What are your thoughts on the international markets? Is that a spot you are looking for investing?
Currency, the US dollar, I think was overextended. I think it got ahead of itself. It got extremely expensive. Would you say, Tracy?
Yep.
I think
Very.
as we look at this and the economies start readjusting to inflation and getting things under control, and central banks across the globe are raising rates, it gives some stability to other currencies relative to the dollar, because everything is really traded against the dollar on a long-term basis. And as a dollar, even if, we stay stable on rates and other countries are getting in line, it does help their currencies on a long-term basis, longer term.
I believe there was a follow-up question there about our position on liking international markets or not. What are our thoughts on international markets at this time?
International stocks.
Oh, as we said, with the international, that benefits the most from from a falling dollar. Emerging markets, definitely. I think we pretty much use a standard diversified emerging markets and international funds. However, if you kind of break it down, China's up about 45% since like last October, so it might be a little ahead of itself. But the key is China's going to try to stimulate their economy. And you got to look and say who benefits from that. A lot more benefit, not so much from the US, is Europe. Germany, France, they really benefit from China stimulation. Then get into the Pac Rim. You got Taiwan, you got the Philippines, you got Vietnam, Malaysia. Those areas should really benefit as China begins to get their economy back on track. So we would say the Europe area is probably going to do well on the developed side, and then the Asia Pacific, excluding China. But China is the biggest piece of emerging markets, but definitely the Asia Pacific area that we would focus on.
Good, thank you. Well, thank you for those questions. We will be available to you as obviously a very community-oriented organization. I want to take the time to thank Betsy and Tracy and all of you for joining us today. I would close by commenting that obviously deciding what to invest in and when to invest in is certainly a challenge. But the way that we continue to work with our clients is through this planning process that identifies a number of different decision points that we take into consideration overall in your life stage plan for you, for your business. And we really do think about how to keep you within that confidence zone that you can, in fact, attain your goals over time. So thank you again for joining us. We appreciate your continued trust and confidence. And with that, we will conclude our call, and we wish you a very enjoyable remainder of the week ahead. Thank you, everyone.